Suncrete, ticker RMIX, Q2 2026. A massive miss across consensus on both the top and bottom lines.
Yeah, an absolute crater on the headline numbers.
Right. Revenue came in at $97.23 million, which, completely missed estimates. The street was looking for something between 99.98 and 101.98 million.
And GAAP EPS was just brutal.
Negative 72 cents a share.
Wow.
Falling woefully short of the -2 to -5 cent estimates. We are talking about a miss of roughly 70 cents per share.
But then management steps up to the mic, and despite this 1,340% bottom line miss, they just completely reaffirm their full year 2026 outlook.
Exactly. And the market's reaction was, well, violent but brief. The stock gapped down 15% in pre-market trading, hitting $16 flat.
But then the buyers stepped in.
Almost immediately. Algorithms, regular session buyers aggressively buying the dip.
Yeah.
By the closing bell, the stock recovered almost entirely, closing down just, 1.86% to around 18.41.
That intraday price action is the entire story here. I mean, a 15% pre-market haircut that gets fully erased by the close. That indicates that once institutional desks actually sat down and read the 10Q filing, they saw something that completely invalidated that algorithmic panic over the headline EPS.
And that is the core mission for this deep dive. For you, the listener, navigating a market that acts this erratically requires looking under the hood.
Definitely.
We need to unpack exactly why the market forgave a 70-cent earnings miss. So we're going to walk through the segment performance, the margin squeeze they're dealing with, management's commentary, and those notable execution risks ahead.
Because the immediate takeaway is that Suncrete is just not the same company it was 3 months ago.
Oh, not at all.
They're in the middle of this massive structural and geographic transformation, and the financial statements are just reflecting the chaotic reality of that transition right now.
So let's focus on that staggering volume growth first, because top-line expansion is undeniably what brought buyers back in at $16. Revenue was actually up 146% year over year.
Which is huge. And ready-mix concrete volumes specifically surged 123%.
Yeah, and even the organic growth of the legacy business was solid, right? Like 9%.
Proving the base operation is healthy, yeah.
But the sheer velocity of that 146% jump was driven by a highly aggressive acquisition strategy. They closed 5 major acquisitions in just the first 60 days after the de-SPAC transaction.
The scale of what they bolted on is, it's difficult to overstate. They acquired Hope Concrete.
That's Texas and Louisiana, right?
Exactly. Then they bought Nelson Bruss Ready Mix to break into North Texas. They picked up ABC Block Company.
Which gives them Arkansas, Missouri, Louisiana, Mississippi.
Right. And then they tacked on 2 smaller bolt-on acquisitions in Louisiana just to, thicken their regional density.
Just to round it out.
Yeah. In 2 months, they added 31 new ready mix plants, 279 mixer trucks, and 8 concrete production plants.
Okay, let's unpack this, because looking at this M&A spree, it feels like watching a python swallow a whole deer.
That is a very accurate visual.
The sheer volume of what they just consumed is staggering.
Yeah.
But I'm looking at this $37.1 million net loss, and I'm trying to reconcile it with 146% revenue growth.
Right, the math feels broken.
Exactly. If the base business grew 9%, and they bought 5 functional companies, what am I missing in the accounting that dragged them down to negative 72 cents a share?
What's fascinating here is how significantly that GAAP net loss is distorted. It's distorted by paper accounting artifacts and one-time transaction fees.
Like what?
So that $37.1 million loss was heavily weighed down by a $26.9 million non-cash charge.
Okay.
That specific charge was tied to the issuance of Class B common stock to an affiliated equity holder, which was in connection with their business combination, the de-SPAC process itself.
So going public via ASPAC triggers these things.
Right. When a company goes public via a special purpose acquisition company, the complex restructuring of shares often triggers these massive one-time equity expenses on the income statement.
So the bulk of the EPS miss isn't operational cash burn at all. It's just a structural accounting penalty for going public the way they did.
Precisely. It's a non-cash expense. They didn't write a $26 million check from their operating account.
Okay, that makes more sense.
Furthermore, they did incur $12.2 million in direct actual cash acquisition costs.
The frictional costs.
Right. Legal fees, advisory fees, tech accounting support, regulatory filings, unavoidable costs when you close 5 deals in 60 days.
So when human buyers realized the underlying operations were moving record volumes of material, and the indigestion was primarily just, one-time M&A fees, the stock rebounded.
Exactly.
But buying all that market share makes for a great top-line headline. Integrating it profitably, though, is where the rubber meets the road.
Absolutely.
The aggressive pace of these acquisitions directly caused the margin compression we saw this quarter. Adjusted EBITDA nearly doubled to $13.5 million.
Up roughly 93% year over year.
Right. And supplemental adjusted EBITDA hit $14.6 million. So the raw cash generation is clearly there. But the efficiency plummeted.
The margins took a hit.
A big hit. Adjusted EBITDA margin dropped to 13.9% from 17.6% last year. Gross profit margins fell by roughly 3.1 percentage points. And operating cash flow was negative $19.6 million just for this quarter.
Driven by higher SG&A and the massive influx of acquisition headcount.
Yeah, but I have to push back on the timeline here, though.
Okay.
If you are bringing in 146% more revenue, burning nearly $20 million in operating cash in a single quarter is a glaring red flag.
It is a lot of cash to burn, sure.
If these 5 companies were profitable standalone entities before Suncrete bought them, why are they suddenly bleeding cash the moment they get consolidated?
Well, it really comes down to the unique logistical complexities of the ready-mix business. Concrete is a highly perishable product.
Meaning the clock is ticking.
Exactly. From the moment water hits the cement and aggregates in the batch plant, you have roughly 90 minutes.
90 minutes.
Just 90 minutes to get it into the drum of a mixer truck, navigate local traffic, and pour it at the job site before it begins to set.
Wow, okay.
So if you are a consolidated company, you absolutely must integrate your dispatch software to route those 279 newly acquired trucks efficiently.
And I'm guessing they haven't done that yet.
Right now, Suncrete is dealing with legacy software systems that do not talk to each other. They are paying for redundant administrative headcount, essentially running multiple parallel back offices.
Oh, that's brutal.
Management explicitly noted it takes 9 to 18 months to bring acquired businesses up to historical Suncrete margins.
Which means they're carrying the cost burden of the acquired companies without yet realizing the synergetic savings.
And the progress across the newly acquired footprint isn't playing out evenly either.
How so?
Well, their October acquisition in Oklahoma City and the more recent ABC block deal are reportedly already hitting target margins.
Okay, that's good.
But the North Texas market, specifically the Nelson Bros integration, is proving much more stubborn.
Why North Texas?
The Dallas-Fort Worth Metroplex is hyper-competitive. It's dominated by large, entrenched national players. Integrating fleets in a congested, competitive zone is creating severe near-term friction.
Makes sense.
However, Chief Financial Officer Tommy Weinroth stated on the call that he expects 60 to 70% of EBITDA to convert to operating cash flow by the end of 2026.
That 60 to 70% conversion target is incredibly aggressive given the current cash burn.
It's a bold claim.
It's essentially the ultimate yardstick for you, the listener, to measure management's competence moving forward. You have to monitor whether this gross profit margin compression is truly just temporary integration friction, or if it's a structural reality of overpaying for lower margin assets in saturated markets like North Texas.
The stakes are very high, and management's reaffirmed guidance relies entirely on a massive acceleration in the second half of the year.
Right. Digging into the earnings call, hitting those numbers hinges on 2 specific elements: the recovery of deferred volume and capturing market share in an unexpectedly high growth end market.
So let's look at the deferred volume first. CEO Randall Edgar spent significant time discussing the unusually wet weather across the Sun Belt during the second quarter.
Yeah, he was adamant that the volume wasn't lost to competitors or canceled, it was simply deferred.
Right, because in construction, if a site gets washed out, the subgrade is compromised. You cannot pour a heavy foundation on muddy, unstable soil.
The contractor halts the pour, waits for the ground to dry, and pushes the schedule.
Exactly. And this dynamic theoretically sets up Q3 to be their strongest seasonal quarter of the year, provided the weather actually cooperates.
They also noted pricing remains highly resilient, and they have implemented indexed fuel surcharges to protect the bottom line from volatile diesel prices.
Which is a crucial defense mechanism when you just added hundreds of gas-guzzling trucks to your fleet.
Yeah, absolutely. But here's where it gets really interesting.
Oh, yeah.
The major growth catalyst management kept hammering on wasn't traditional residential subdivisions or commercial office parks, it was artificial intelligence data centers.
The AI boom reaches cement.
During the call, they highlighted that 70% of new data center construction nationally is happening precisely within their newly expanded Sunbelt footprint.
And these are monolithic projects. We're talking 40,000 to 50,000 cubic yards of concrete in phase 1 alone.
eventually scaling up to 500,000 yards over multiple build-out phases.
It's massive.
But honestly, I see a massive irony here. You have this legacy, dirty boots, aggregate and water business suddenly trying to pitch itself as a backdoor pure play on the AI boom.
It sounds like a stretch, right?
Yeah, do they actually have the physical and logistical capacity to win these bids? Or is this just management slapping the AI label on their earnings call to appease Wall Street?
It sounds exactly like a buzzword grab until you examine the mechanical reality of pouring a data center foundation.
Okay.
If we connect this to the bigger picture, the recent 60-day M&A spree was executed almost entirely to capture this specific market.
Walk me through the mechanics of that. Why did they need all those trucks for data centers?
Consider a 500,000-yard data center facility. These structures require incredibly thick, highly engineered, load-bearing floors.
Right, to support the servers.
Exactly. The staggering weight of thousands of dense server racks, industrial liquid cooling systems, and massive power redundancy infrastructure.
Yeah.
To ensure the structural integrity of a slab that massive, the concrete pour must be continuous.
Meaning no stopping.
None. If you stop pouring and let one section dry before the next batch arrives, you create what's called a cold joint, basically a seam of structural weakness where the two pours meet.
And that is unacceptable for a hyperscaler data center.
Completely unacceptable. You need an endless, unbroken chain of trucks arriving at the site for days at a time.
So you cannot physically win a bid of that magnitude with a localized fleet of 30 or 40 trucks.
No way. If 3 trucks blow a tire or a local batch plant goes down for maintenance, the continuous pour is broken and the foundation is ruined.
Ah, so Suncrete's new density, adding those 279 mixer trucks and 31 plants across regional hubs.
Yeah.
That gives them the logistical redundancy to guarantee a continuous pour.
Exactly. They bought the fleet scale necessary to sit at the table with the massive tech infrastructure developers.
That reframes the entire acquisition strategy.
Mm-hmm.
They couldn't bid on the AI projects until they had the Python-sized scale to absorb the workload.
Right.
The AI narrative and the accompanying top-line growth are compelling, but, executing it requires immense capital. And that introduces the massive balance sheet risks we need to address.
Definitely. Heavy materials is one of the most capital-intensive industries on the planet, and Suncrete has levered up significantly to build this machine.
Total debt right now sits at $218.5 million. Liquidity is stable, but relatively tight, at $51.1 million.
Which consists of $28.6 million in cash and $22.5 million in available revolver capacity.
They just completed a Fifth Amendment to their credit agreement, too.
Right. This secured a $175 million delayed draw term loan, a $100 million accordion feature, and doubled their overall revolver capacity to $50 million.
But if you look at their reaffirmed full-year guidance revenue of $420 million to $480 million and adjusted EBITDA of $68 million to $93 million, they are banking on massive profitability to service this structure.
They really are.
So what does this all mean? With $218.5 million in debt, any significant weather delay or macroeconomic construction slowdown could be devastating.
It's a precarious position.
I look at this debt structure like curing concrete. It takes time to harden and settle, but if you apply heavy macro pressure too early, the whole foundation cracks.
That's a great analogy. The debt load is undeniably large, but corporate finance evaluates leverage relatively, not absolutely.
Okay, unpack that.
Yes. The gross debt number surged, but because their EBITDA grew so rapidly from bolting on those 5 cash-flowing acquisitions, their actual leverage multiple dropped.
Oh, interesting.
Yeah, they were sitting at 3.4 times leverage at the time of the de-SPAC. They are now down to 2.5 times leverage.
So the denominator, their earnings power, outpaced the numerator, their total debt.
Precisely. From a strict credit perspective, they are mathematically in a healthier proportionate position now than they were before they went on the shopping spree.
That makes the credit amendments make much more sense.
It also explains the mechanics of their new debt facilities.
The accordion feature.
Exactly. That $175 million delayed draw term loan and the $100 million accordion feature are essentially pre-negotiated mechanisms to expand their credit limit quickly.
Right, because an accordion feature allows a company to increase its line of credit with existing lenders on the same terms without having to draft entirely new loan agreements.
Yes, and it proves their banking syndicate is highly comfortable with their M&A integration strategy. They are already greenlighting the funding for the next round of targets in their pipeline.
But this raises an important question regarding their operational execution for the back half of 2026.
The math required to hit their reaffirmed guidance.
Right.
The math is entirely unforgiving. They posted a $38.9 million GAAP net loss in the first half of the year.
Right. So to hit their reaffirmed guidance, which calls for adjusted net income to land somewhere between a $4.3 million loss and a $20.2 million profit.
That requires an absolute masterclass in execution for Q3 and Q4.
They need everything to go right. There is zero margin for error here.
None. The integration friction in North Texas has to be resolved immediately.
They need a quiet, mild hurricane season in the Sun Belt so those deferred pours can finally happen.
And most importantly, they have to prove they can convert that 146% revenue growth into actual flowing cash.
While simultaneously managing the mind-bending logistical complexity of a geographic footprint that just doubled in size over 60 days.
It is the ultimate operational stress test for the next 6 months. They spent the money, they built the massive regional network, and now they have to prove they can actually drive the machine without crashing it.
And you can guarantee the market will be scrutinizing that operating cash flow line with a microscope next quarter.
Absolutely.
Which brings us to a final unmentioned scenario for you to ponder before we wrap up today.
Let's hear it.
We've spent this time discussing Suncrete levering up, taking on debt, and expanding their heavy fleet to meet the massive immediate demands of hyperscaler AI data centers.
Right.
But what happens if big tech suddenly pivots?
Ooh.
What if the AI infrastructure spend scales back abruptly? Or what if the major players realize the Sunbelt power grids simply cannot support the energy demands of these facilities and they're forced to build elsewhere?
That is a scary hypothetical.
Right. If that localized data center boom evaporates, regional materials companies like Suncrete could find themselves severely overleveraged.
Just holding a bloated, depreciating fleet of 279 mixer trucks and excess plant capacity they no longer need.
Exactly. If the prize deer manages to run away, that massive python is going to be left exhausted, starving, and incredibly vulnerable.
It is a vital, sobering thought for any investor trying to ride the secondary hard asset waves of the AI boom.
Definitely a dynamic you need to keep on your radar. Thank you for joining us for this deep dive into Suncrete's highly complex Q2 earnings. Be sure to follow the show for daily, no-nonsense earnings coverage, breaking down the underlying mechanics that actually matter to your portfolio. We will see you next time.